James Blackhall's JB Commercial Finance here. Now I've done a few videos recently which I call explainer videos, and basically in preparation for my upcoming book, which is going to be called Small Business Lending Simplified. It's a few videos for those of us with slightly less attention span with regard to real fundamental things about small business lending which may be useful to those of you looking for this in the future. Now this very brief video is going to be about the difference in secured and unsecured lending and when that cut-off point occurs. Now secured lending is pretty much as it says. It's lending money from an institution which has got background security in place. Now I'm not talking about personal guarantees, because any limited company lend will involve those, but I'm talking about background security and generally has to charge over property. So if you're lending money to a company who has got property assets, then it's not unreasonable for a lender to look for a legal charge over those. That would mean that in case of default on the loan and the debt falling into arrears or the business ceasing to trade, then the lender can go and effectively repossess those properties that get their debt back. Now that's not really good for anybody because there's costs involved on the lender's side with regard to legals and auction costs, etc. And also that the borrower, the company, probably is going to get their full money back, their full realisation of the value of the property, because it's sold very cheaply just to get it off the books and just to repay a debt. Now, something that's increasingly common, but it's very stably common now, if that makes sense, is a director or a proprietor of a business offering a charge over their own residential property to secure company debt or secure debt in their sole trader or partnership name. So money may be granted to a company, let's just pick a figure out of the hair, £100,000, and while the lender is happy to lend to that customer, that limited company, they'll say, we'll do it on the proviso we have some background security, which is a charge over the director's house. Again, this can create some issues because it takes time, it's a valuation involved. Also, if there's a partner involved, a husband or a wife, they may have to take some independent legal advice, which is a cost and a bit embarrassing at times. So I quite often get asked the question, how much can I borrow without actually giving personal security? And it's impossible to answer to an extent, and peer-to-peer lending has really changed that marketplace. So from a high street bank point of view, traditionally the point where they would strongly have to think about taking personal security is anywhere between, I'm going to use my whiteboard here, £15,000 and £25,000. So a bank would have an application for £20,000 if it's a very strong customer, existing customer, then they may well do that without any background security. They probably would. If it's a new startup business, and even if they were looking at the lower end of this figure, they would probably still want some background security. But certainly when a bank manager has to put a report together for his underwriters, he would have to justify the taking or non-taking of security at this level. Now, a lot of that's changed in recent years. While banks have maintained this kind of position, lenders such as the Funding Circle and similar have come along and they're prepared to offer a lot more on an unsecured basis. So, for instance, the Funding Circle's maximum loan they publish is £350,000, and that is unsecured other than a personal guarantee. Very important that a personal guarantee is a legal document that will hold you to repaying it, but they don't have a charge over your personal assets. So, also, many of us, including myself, who are preferred partners with the Funding Circle, can actually look at a figure up to £500,000, again, unsecured. Now, these don't really fall on your doorstep every day, to be perfectly honest, but certainly this figure, I've recently completed a Funding Circle deal for a client for a loan that size. That's an unsecured loan. And no matter what banks say, they wouldn't even dream of coming close to this. The reality is, banks, even for very, very good customers, are only going to consider that sort of figure, £50,000, at a sort of level we're talking about, small SME lending. And even that, to be perfectly honest, is a massive, massive stretch. The reality is, if they're looking to borrow over £25,000, they're probably going to have to pledge personal assets to the bank. Now that may well be worth doing if it gives them a cheaper rate, a longer term, if they've got a good relationship with their bank, whatever it may be. But more often than not, a customer will prefer to borrow that figure, even if the interest rate is slightly higher on an unsecured basis, because they're not having to pledge personal assets. And the cheapest and quickest way of doing that is via a peer-to-peer lender, via someone like myself, rather than the bank. So while there is no hard and fast rule with regard to a cut-off point for secured and unsecured lending, this is the figure where the banks have to justify not taking personal security. And as a former bank manager, if you're thinking of lending that sort of amount, £25,000 to a limited company, and you have any doubts about it, you're always going to propose taking that security in case it comes back to haunt you down the line. I hope that's helpful. Very, very simple, but it's a question I do get asked a surprising amount of times. So hopefully this will all come together, and when the book comes out, you'll find it interesting, useful. A lot of you might even buy it. I'm James Blacklaw. My business is JB Commercial Finance. Please like, subscribe, and share these videos. I'm hoping they're of use to you, and I'll see you all very soon. Thanks a lot.